Hey guys, my name is Max Convexity. Thanks for tuning in to the channel. I have a good one tonight. It's called Why is BLOX, Curb Stomping, LFGY, and ULTY. Stick around, we'll get right in the middle of it. I think this is a fair comparison. These are similar ETFs, as all of these ETFs give you exposure to decentralized finance, technology, and indirectly to Bitcoin. I want to check in on these ETFs. They have stocks in common. They all have Hood, Coinbase, and MicroStrategies, and there's a number of stocks that at least two of them have. Now, full disclosure, I own LFGY and ULTY, and I've been happy with them. However, since BLOX was introduced a little over a month ago, it's been outperforming on total return and NAV return. LFGY does yield about twice as much as BLOX, however, and BLOX hasn't been around that long, and projecting the dividends out this far could be inaccurate. They've only been around for about a month. I think it's safe to say that ULTY and LFGY both, even after BLOX has been around for a year, will yield more. So let's look here. Let's talk about the curve stomping first. This is BLOX against LFGY. BLOX is in the bright blue. Look at BLOX. They've been around a month and a half. Starting share price 38.62, ending share price, that's LFGY. Or in the past month and a half, LFGY has gone from basically 38.62 to 38. They've lost 62 cents in NAV. Over the same time frame, BLOX has gone from 19.17 to 22.97. They're up about $2.70 in NAV, which is pretty good. When you think about it, LFGY is doing fine also. Their NAV is hanging in there. Of course, if you look at the dividends per share, that's where LFGY really shines, and they're beating it on an actual basis and a percentage basis. LFGY is only up 5% for a month and a half, but think about that. Only up 5.8% for a month and a half. You know, that's 49% annualized. That's pretty good. But then when you look over here at BLOX, up 22.99%. We're going to try to figure out why that is. You know, that's an annualized gain of 195%. Now, granted, it's just a month and a half, very small sample size. Now let's check out ULTY versus BLOX. BLOX, again, is in the bright blue and is once again curb stomping ULTY. Now, ULTY is doing a little bit better over the past month and a half as opposed to LFGY. It's got about twice as much upside. It has, or twice as much total return, I should say. It has a total return of 10%. Speaking of upside, though, when I talk about upside, I'm usually talking about NAV upside, which can help with total return for sure. But ULTY has been basically up 4 cents. We'll just call that flat for a month and a half. 10% total return, which annualizes out to 84%. Now, BLOX, on the other hand, once again, I mean, they're up, they're up good in both categories, up 10-15% in NAV and also paid a pretty good dividend so far. At this rate, it might come to 25 or 30%, but it's probably inaccurate to judge off such a small sample size. But just doing a back of the napkin estimate, that's what I'm thinking. Maybe 30, 35 for BLOX, something like that. We'll see. We'll see. It depends on there's lots of factors that go into it. That's why I was cautioning us to just judge them by a month and a half's worth of dividends. All right. So like I was saying, ULTY and BLOX are higher yielding. Now the yield is a tax on the NAV. The yield is paid, the dividend or the distribution in this case is paid out of the net asset value. So the yield is essentially a tax on the future upside of the net asset value. As such, it shouldn't be too surprising that the YieldMax ETFs are behind in NAV return. They're both behind in NAV return, even though they were both doing pretty decent. You would definitely call them both stable. And, I'm not a big believer in using that word. I think it's kind of misses the point, but we'll talk about that some other time. All right. So what goes into BLOX's total return? How the heck are they doing so well? So first of all of these ETFs, so the three of them are actively managed, and they have managers, professional managers, that are passionate and talented, and they try to put the best stocks in the portfolio at any given time they can. But they also look at the option trade part of it. So typically they try to pick the best stocks that also have a really high implied volatility, so they can pay a high yield. All right, so let's look at the BLOX positions. So BLOX is in, and it looks like they started at 5%, but they're in Galaxy, Coinbase, Riot, Robinhood, NVIDIA, Block. It makes sense. BLOX is in Block, right? Taiwan Semiconductor, Mara, Hut 8, or whatever that's called, MicroStrategies. Now, they have a lot of cash. Good job, BLOX. They have more than 20% cash. That'll help them out today because market sold off and closed on the lows. Then they have Circle, and they also have an ETF called HODL. They have a lot of that. And they also have BMNR and a little bit of some other ones. All right, so let's look at the ULTY positions. They have Applied Optoelectrics, AppLovin, AST, Bitmine Immersion, that's BMNR on the other one, Webull, Coinbase, First Solar, Galaxy Digital, Robinhood, Inundated, INOQ, Mara, Facebook, MicroStrategies, Nebius, Oklo, Palantir, Qualcomm, Reddit, Rigetti Computing, Supermicro Computer, Nusco Power, Snap, Tempest AI, Upstart Holdings. And I love this. They have VIX futures, not really VIX futures. They have an ETF called UVIX, which is essentially, it's a long volatility play. So that works as a hedge. Volatility typically goes up when the market drops. Then they also have Vertiv Holdings, Vistra Corp, and they have a pretty good amount of cash, 6%. Not as much cash as BLOX had at 21%. Now let's go down here to LFGY. LFGY has that Bitmine Immersion, or I keep forgetting what that's called. Is it Bitmine Immersion? That's the last time I'm going to look for it. Bitmine Immersion Technologies. Okay, Bitmine Immersion. They also have BTDR, CleanSpark, Coinbase, CORZ, Circle, ETHA, a little money market, a little Galaxy, GME. They're the only ones with GME. Robinhood, Hut, IBIT. IBIT's a good ETF, Bitcoin-based ETF. Mara, Melly, MicroStrategies, NU, NVIDIA, Opera, PayPal, Riot Blockchain, and Block again. Coinbase and Robinhood are in both portfolios, and actually so is MicroStrategy. So it's in all three portfolios. And like I say, there's plenty. Block is in 2 portfolios. Mara is in 2 portfolios. But for the sake of tonight, we're going to look at those stocks that are in common. And we're going to check out a couple of back tests. And it's important to know why BLOX is doing so well right now. And we're going to talk about path dependency. We're going to look into that. But we're also going to talk about the option strategies. These guys are going to put the highest IV stocks they can find, in the case of ULTY specifically, or particularly, and they're also going to try to choose the best stocks they can. I mean, they're also, because covered calls are bullish strategies, and these are all forms of covered calls, so they're long the market. Now, they do different forms, and we're going to get into that here in a second. ULTY uses callers, LFGY uses covered call spreads, and BLOX uses the vaunted lightning spread. So we'll talk about that. So let's go right here. So first of all, let's just quick refresher course on the strategies. So we're going to start with BLOX. All right. Well, actually, no. Let's start with ULTY. This is most familiar. Okay, and I pulled this trade or this position off the current positions. Now this expires tomorrow, and they put this on probably a while back. But just the theory of what ULTY is doing with MicroStrategies. We'll just look at MicroStrategies to compare all of these. They're selling a call, and they're using part of the money from the sold call to finance a put. it gives you a risk reward graph like this. You make money up to a point and then you're totally capped out. But the other side is you only lose money to a point, and that's because of that collar. And so in this case, MicroStrategies would have to drop more than 6.7% at expiration. That's the good news, because then they don't have any further losses. The bad news is they could drop 6.5% at expiration and still suffer the same loss and have no protection, essentially, other than the premium received from the excess premium. Typically the call is a little bit more than the put, and they have an excess credit. The credit goes to pay your yield. So that's covered call spreads 101. So let's look at the next thing. Now, we're looking at the red and green line. The white line is the lightning spread, but the red and green line is an interesting trade. This is also on MicroStrategies, and this is a covered call spread. So a covered call spread is stock plus a covered call and selling an out of the money call. So in this case, the 430 was sold. Okay. Now in the case of ULTY, it was the 420, but that's what they have in common. They sell a call, but then instead of buying a put with the leftover, some of the leftover money, they go out further out of the money and they buy another call. They spread off their risk. They're putting on a covered call spread. So what that gives you as far as profit and loss goes is you make money up to a point, and that's right up to 430, and that's about 6.9%. So in other words, the NAV makes money. The fund's NAV makes money. There's two things. There's the NAV and there's the yield. Think of them in two buckets. But this trade is put on for a credit. That credit goes to pay the yield. That's in the yield bucket. At the time you have to settle up the trade, you settle up the trade when it expires. It expires tomorrow if they don't roll sooner. But just saying they go to expiration, it settles up tomorrow. When it settles up, whatever happens, that goes into the NAV bucket. The yield bucket is what it is. It's whatever the yield is. It'd be $94 in this example, but that's the yield bucket. So the NAV bucket. So what they're hoping for is the market goes up 6.7%. or a lot more. But the catch to this trade is you're tapped out between 6.7% up and 12% up. You won't make any additional money. But if you go up more than 13%, then you start making additional money again. So there's no other ETFs that I know of that do this strategy other than Yield Max. The disadvantage to this strategy is there is no downside protection. Other than this credit received, there's a small credit received when you do the covered call spread. So you do lose, in this case, $94 less than stock would lose, but there's no protective put. They can just lose whatever the market goes down. So that's the covered call spread. That is a more aggressive strategy than ULTY. ULTY is the safest of the strategies we looked at so far. This is the second safest, or the first most dangerous. Let's just look at it that way. Okay, so now we're going to go to the vaunted lightning spread. All right, now this thing's something else. Okay, so let's talk about our buckets again. These aren't retirement buckets. These are trading buckets, option selling buckets. All right, so well, first of all, what they do, and I got this from the positions on BLOX. So, and they had several on. I just took one of the positions. They have it laddered, but this one, I use the one that's the furthest out of the money, just for whatever reason. But so they have what they do is they sell a put, usually at the money, but then they buy a put for a little further out of the money. So instead of doing a covered call spread, this isn't a covered put spread. Maybe it is. I guess you could call it a covered put spread, but really I think of the stock plus a bull put spread. And a bull put spread is where you sell the option that's more expensive, that's closer to the money, and then you buy one further out of the money. So that creates a credit also. Those two options create a credit. So that's good. The credit goes to pay the yield. So that credit goes in the NAV, the credit goes in the yield bucket. Okay, but the NAV bucket, well, we don't know what goes in the NAV bucket until the trade is settled. I think this is a concept maybe that it needs to be explained better, but when you put on the trade, you get a yield right away in all of these cases. But when the trade is settled, whatever happens there, that either puts money in the NAV bucket if it's a bullish trade, or it takes money out of the NAV bucket if the trade loses money. Okay, now this is the most aggressive of the three strategies. You'll see here this white line, I overlaid the covered call spread. Now the covered call spread, you have unlimited loss on the downside. Goes 1-to-1 down with the market. Other than that it does have a little cushion from the call income, from the call spread income. Okay, so this one though, the thing about this one is if the market goes up, they don't have to settle this trade. The put spread expires worthless, and they make more money on the way up. Between the strikes, they're making money twice as fast. They're essentially double long between the strikes. But then above the top strike, they make money just the same as stock would make. This is the most aggressive. It's the most bullish, but it also has the least amount of downside protection. Now, they do get whatever their credit was. They do lose a little bit less than that. The problem is, though, the path dependency comes in a big down market, or a down market that goes through the strikes, that goes through the bottom put strike. They lose because they have to settle that trade, and they have to settle that put spread for a loser. This would be the equivalent of the flat spot on, or look at it this way. When you have to settle this trade that ULTY does, if you have a big up day, you have an opportunity loss. If you have a big down day, you lose, but you capped out. You can only lose so much. That's not the case with blocks, with the lightning spread. It actually loses, and it loses at a faster rate than either of the other two strategies, and it's not capped. So what does that tell us? So that tells us that I would expect BLOX to outperform in a bullish market, and the other ones to outperform in less bullish markets. And probably ULTY, if you had to, none of these are really safe, but ULTY is the safest of the three. But they're all aggressive strategies, is what I mean. And you can lose on all of them. Even ULTY, if you don't go down past the put spread, you'll still lose the same as stocks. You could lose 5% 4 weeks in a row and be down, what is that, probably 15% or something like that. It's not 20%, but it's probably 14, 15%, something like that. So, I mean, so it's not like it's far from totally protected, but if you have a week that's down 10% or 20%, you don't have to worry about that. So once again, ULTY is the most conservative. The second most conservative is the yield max strategy, or LFGY, and the most bullish, but with the least protection, is blocks. Okay, so what does that mean? So I think what we have to realize is blocks, if we hit a bearish market, blocks will likely outperform these on the downside. Now, that's other things being equal. These managers aren't just putting these spreads on and forgetting about them. They're very actively managed and stuff. But to the extent that they all have a spread on, and then the market drops 20% the next day, a black swan hits or something, blocks would have the blocks' NAV bucket would be taking money out of it. There'd be money coming out of the NAV bucket. There'd be money coming out of all three buckets, or out of all three stocks out of the NAV side. Now, the yield side's good. The yield side that you get off the front, you never have to, you always get that. It's just when you settle the trade. So you can see here on blocks, great strategy, but if you have to settle several, if you have several down 5% days in a row, you're going to be down every bit of 5%. If you have a 20% down, you're going to be down 20%, less the income off the put spread. The put spread does produce an income. Like I said, this is probably the first one they had on, and the market's moved. So, but this is the general theory. And the reason they call it the lightning spread, you can see it looks like a lightning bolt. It goes like this, and then it goes like this, and then it goes like this. The area where it has a steeper incline is the area where you're double long. Between that area, you make or lose money at twice the rate of stock. It's like you have 200 shares instead of 100 shares. Okay, so now let's look at this a little bit further. I thought this might be interesting. Let's go back a year and look at micro strategies, and let's look at all three strategies. So here we're gonna test the first. Let's test the BLOX strategy. So this is the lightning spread. So it's, once again, it's stock plus selling a closer at the money put and buying a further out of the money put. Doing it every week. Now let's go back a year and see how this did. No stop loss, no anything, just let it expire. Like I say, and this is just going to show us how the option strategy does in isolation, and that's not really how it works. These guys are going to manage it and stuff, but still, it's important that you can see the trades, the winning trades getting settled and it going into the NAV bucket. You can see it right here. You can kind of see how it works. All right, so MicroStrategies has had a heck of a year, so they haven't had to settle very many losing trades. So even though that's kind of a disadvantage of the lightning spread, hasn't really hurt them that much. And in fact, I mean, they protected capital better than MicroStrategies did. The strategy was only down 21%. MicroStrategies was down about 50% at the worst point. Unfortunately, they still left a little bit of money on the table. But if you look at the MAR ratio, their risk-adjusted performance was pretty good. In other words, because they only lost half as much. Yeah, they didn't quite make as much either, but they're a lot safer. So that is the lightning spread. So now let's compare the lightning spread. We're going to remember 49.6. Let's compare the lightning spread to the covered call spread. Now the covered call spread, we'll just use the same strikes. They could sell a 40. That's one or two out of the money. Covered call, that's their covered call. And then they could buy a 30. So that's probably 3 or 4 out of the money. It depends on the volatility. And if they do that every week, let's see how that compares. All right. So they didn't do as well. They only had about half as much total return. So they left quite a bit of money on the table. Now, however, they did have better downside performance. Their max drawdown was less. There wasn't a lot of downside this past year, although MicroStrategies did drop quite a bit in April, but both strategies have protected capital fairly well. BLOX has got a lot more upside, about twice as much total return, and it would also a lot more upside. Okay, so now let's go to the last strategy, and that is the caller, the covered caller. So that is stock plus selling an out of the money call. So we'll just use the same strike to make apples to apples comparison. We'll use a 40 strike. That's two or three strikes out of the money. Okay. But instead of buying a call, further out, like we would do on a call spread, we're going to use the money from the income from this to buy a put. So all we have to do is switch that to put. And we'll just use the same strikes. And a 30 delta put, that's a good looking, that right there is a good looking caller strategy. Now let's see how this would have done. So this is the ULTY strategy for the past year. No management, a passive caller strategy. So to the extent that it reflects the fund's performance, we'll see what we can glean from this. Okay, well, the caller strategy got least upside, and that doesn't surprise me because it's 100% capped. Okay. However, it also got the least amount of downside. It only got 9% on the downside. That's really wonderful. That is wonderful. I mean, left a lot of money on the table, but if it's about income, let's see how much income we got. The Tasty Trade isn't sophisticated enough to do this, but we just have to test the caller by itself to see what income came in and then put the stock back in there. Okay, so you can see the caller itself was a loser. It was a loser just by itself. A big loser. But that's not why we have it. We have it for this. See where it says average premium, $199. Okay, well, that adds up over the course of a year to $10,000. All right, so let's go put the stock back in. All right. All right, so I mean, the caller does a great job protecting capital, and it makes a yield. Good stuff. Okay, so let's look. Also, they have Coinbase in common. Let's go to Coinbase and do the same thing and see if it holds true. So what would you expect? Well, this time we'll start with the caller. So what would we expect? We'd expect the caller to be the safest, but to have the most cap, to have the worst upside performance. Sure enough, this one left a lot of money on the table versus just buying and holding. Tons of money on the table. The drawdown was like 5 times better than buying and holding, but this is not a great look for the caller strategy. Okay, so next let's try the second most aggressive, which would be LFGY strategy, or the covered call spread. So let's put that in and see if that does better. All we have to do is switch this to a call. There we go. Covered call spread. Let's see how it does. Oh, great. Now look, this did a lot better. It got 41%. It still left money on the table compared to buy and hold. They virtually always do. That's just kind of the way it goes. But this did well better. And look at this. This MAR ratio is risk-adjusted reward, and it got almost twice the risk-adjusted reward. That's really impressive. The covered call spread was a good look in Coinbase. Now, to be fair, it had about twice the drawdown of the caller strategy. So that's kind of to be expected. Okay, so, it had twice the drawdown of the caller strategy. That's to be expected. Okay, now we're going to go to the most aggressive of all of them, the lightning spread. Let's see how that does. We're trying to beat 41% total return, and we're just going to see how it compares on a 17% drawdown. So all we have to do is switch to puts. Use the same strikes to be consistent. 43%. It has a little bit more max drawdown, and we would expect that, remember, because of this. Because you can see it outperforms the covered call spread on the downside, just because of the fact that when you only have to settle losing trades in markets that go down, you don't have to settle losing trades. They expire, and you make a full profit in a market that goes up. So Coinbase has been choppy. I think that test came in just exactly like I would suspect. And the return on used capital was very close. They both did very well. Okay, so now let's go over to the third one that's in common. It's not NVIDIA, is it? It's Hood. Yeah, it's Hood. So we'll go back to the okay, let's start with the ULTY strategy, the covered caller. We're using the same strikes, same everything, 5 days till expiration on the ULTY strategy. Okay, it protected capital really well in Robinhood. It was only down 4%, where Robinhood was down 47% from top to bottom back in March and April. Okay, well, they did also get 23%, return on used capital, which isn't bad for a year. It's really good. However, the underlying got 420%. So, and how does that happen? Well, we have to think about the path dependency. Here's what a caller looks like. So when you put on the trade, it goes in the yield bucket. So what happens when you take a trade off the NAV bucket? That's what goes in the NAV bucket. Okay, so if they have to settle a lot of bullish trades, they get a lot of trades for small winners, but they never get a big winner because they're totally capped. So if you look at their NAV bucket, you can look at their NAV bucket as the total return. It's similar, but they don't have nearly as much total return as this one, because as Hood itself did, because Hood was very bullish and they were totally capped, although it did a great job protecting downside. Okay, so now let's look at the middle of the road strategy. We'll look at the LFGY strategy or the covered call spread. So we're going to sell a call and then buy a call. Yes, and buy a further out of the money call or a lower delta call, selling the 40, buying the 30. All right, so what we'd expect, I would expect more worse performance on the downside, so probably a bigger drawdown, bigger max drawdown, but I would also expect, because we're partially uncapped, I would also expect better upside performance. The last one we got, what was it, 23.8 or something? Let's see what this one does. Nice job. Okay, we got about twice the upside or twice the total return. That's wonderful. Now, we did have a bigger drawdown. We were down 14%. We still protected capital well compared to the other strategy. Great job. Okay, so now let's check out the block strategy. This is the most bullish strategy of the three, and this is on the most bullish stock we've looked at so far. Heck, it's up 420% on a year. All right, so let's go load up the block strategy. All we have to do is switch both of those to puts, use the same strikes, and this would be a decent representation. Okay, drawdown was a little bit more by just 1%, but the return was better, and it was the best of the three of them, and it's the most bullish. Great job. They all did a good job of paying yield, but depending on how the trade was settled, and that depends on what the market was doing. Were a lot of trades settled on the bearish side, or were they settled on the bullish side? Even the trades that are settled on the bullish side are good, like in the case of ULTY. It can be a winning trade, but they can still be leaving money on the table compared to the underlying, and especially more money on the table compared to these other strategies. Like I say, with ULTY, it's especially with that Coinbase test, that's not the most fair comparison. I'm just trying to illustrate the way that option strategies and having to settle up the trade affects the NAV. And I was hoping and thinking this might be a good way to illustrate that. All right, so the caveats to this study are these were passive option strategies. All of these funds are actively managed, but to the extent that the option strategy, affects the return, this is kind of the mechanics of how it happens. And I thought it'd be good to go over this. But as far as blocks, I'm going to say that as long as the market stays on fire, it's going to keep stomping these other ones. But if the market goes back to an April situation, I would think, just based on the option strategies, that they might lose at a faster rate, especially at a faster rate than ULTY, than ULTY, because ULTY is totally capped on the upside and the downside, which can be really good in a down market. But the caveat to that is, I want to reiterate this, is that as good as the puts are, they aren't magic. You still have a large area that you could lose. A 6% loss is bad, and you don't have any buffer there. But if you get a 12% loss or 17% loss, then your NAV bucket starts looking a lot better than the other person's NAV buckets, for sure. All right, guys. Well, I hope you guys liked this video. Leave me a comment if you have one, and let me know what you thought. I'm going to drink this and get out of here. Have a good night.